Japan is back. After decades of stagnation, Japanese stocks have quietly been outperforming many global markets. Warren Buffett has been buying. Global funds are rotating capital into Tokyo. And suddenly, UK investors are asking one question: how do I actually invest in Japan? Because it's not as straightforward as buying a UK stock. There are currency differences, different exchanges, different tickers. So, in this video, I'll break down exactly how UK investors can access Japanese stocks. The simple way, the advanced way, and the smartest way for most people. Let's start with the easiest option. If you want broad exposure to Japan without picking individual companies, the simplest route is an ETF. An ETF is a fund that trades like a stock and holds dozens or even hundreds of companies. For example, funds that track the Nikkei 220 or the Topix index give you exposure to Japan's largest listed businesses in one single purchase. Many UK platforms offer Japan-focused ETFs that are listed in London, meaning you can buy them in pounds without needing a foreign brokerage account. This removes a lot of friction. You get diversification, reduce single stock risk, and you don't need to worry about translating financial statements. For most investors, this is the cleanest way to gain exposure. But what if you want individual Japanese companies? Let's say you want to own Toyota, or Sony, or Nintendo. Companies like Toyota Motor Corporation, Sony Group Corporation, or Nintendo. There are three main ways to do this from the UK. Option 1. Buy the stock directly on the Tokyo Stock Exchange. Some international brokers allow access to overseas markets, including Japan. However, this usually involves higher trading fees, foreign exchange charges, and sometimes minimum trade sizes. You'll also be buying in Japanese yen, so currency risk becomes more direct. If the pound strengthens against the yen, your returns can shrink, even if the stock rises. That's something many investors overlook. Option 2. Buy Japanese companies that are cross-listed in the United States. Some major Japanese firms trade in the US as ADRs, American Depository Receipts. These can sometimes be accessed more easily through global investment platforms. They trade in US dollars, which can simplify things compared to buying directly in yen. But again, currency exposure still exists. Option 3. Use a Japan-focused ETF, but overweight it towards specific sectors you believe in. For example, Japan is strong in automation, robotics, semiconductors, and automotive manufacturing. Instead of picking one company, you gain exposure to the entire theme. This reduces the risk of choosing the wrong stock. Now, let's talk about accounts. If you're investing from the UK, you can hold Japanese exposure inside a stocks and shares ISA. That means any gains or dividends are tax-free. This is one of the biggest advantages UK investors have. You don't need a special offshore account. Most mainstream UK platforms offer access to international ETFs within an ISA wrapper. Just check whether the ETF is UK domiciled or UCITS compliant, as that's typically what platforms support. Now here's something important. When investing in Japan, you're not just making a stock bet. You're making a currency bet as well. If the Japanese yen weakens significantly, it can reduce your returns when converted back to pounds. Some ETFs offer currency-hedged versions to reduce this risk. Others leave you fully exposed. Neither is automatically better. It depends on your outlook. But you should know which one you're buying. So why are investors looking at Japan right now? Corporate governance reforms have been pushing companies to improve shareholder returns. Share buybacks have increased. Balance sheets are stronger than many Western companies. And valuations have historically been lower compared to US markets. Even investors like Warren Buffett have increased exposure to major Japanese trading houses. That's drawn global attention. But remember, no market moves in a straight line. Japan had decades of underperformance before this resurgence. So diversification still matters. If you're just starting out, a broad Japan ETF inside a stocks and shares ISA is likely the simplest and most efficient route. If you're more experienced and want targeted exposure, direct shares or ADRs may suit you better. The key is understanding fees, currency risk, and platform access before you click buy. Japan is accessible to UK investors. You just need the right route. So the real question is, are you looking for diversification outside the UK and US? Or are you chasing performance after headlines? Because how you enter the market matters just as much as what you buy. Let me know. Would you invest in Japan right now?